In this video, I would be covering direct tax amendments as applicable for June and December 2025 exams. See, this is mainly focused for June exams. If at all, if there is any separate amendments for December, then you will get it as a separate video also. But this would be applicable for both, but these are the changes from last December to June exams, guys. So what are the changes? I have prepared one reference material. Chapter wise amendments, I have arranged it in one places, so that if you guys are referring along with the study material, you can update it then and there itself. So we'll start with, now for those students who are appearing for June 25 or December 25 exams, sir, what is the Finance Act applicable? It is Finance Act 2024. Accordingly, the previous year would be 24-25 or assessment year 25-26, guys. Any questions in the exam for you would be asked for previous year 24-25 or assessment year 25-26. And I have taken the contents here from my regular study material, which you guys might already be having it. But don't focus on what is there in black. Focus on what is there in red. Sir, then why you have taken? Because I cannot keep only amendments. You might get confused. So I have taken the topic. In that topic, what is the change or amendment? So that it would be easy for you guys to update. So the amendments or changes I have highlighted in red color, guys. So first change is with respect to chapter 2.1, which talks about basic concepts of income tax. Finance Act is there, guys. We already learned how bill will become act and all. There is no changes or amendments in it. Finance Act 2024 would be applicable from 1st April 24, and it is applicable for your June 25 and December 25 exams. Okay, previously it used to be Finance Act 2023, but now it is 2024. Next, coming to previous year, definition there is no change, but only the year has changed. For June 25 and December 25, what is the previous year, sir? 24-25. Guys, I already mentioned, any questions in the exam normally will be asked for previous year or assessment year. It will be 1 year plus previous year plus 1 year will be assessment year. So for you guys, whatever would be asked in the exams in direct tax would be for previous year 24-25 or assessment year 25-26. Yeah. Now coming to tax rates, one of the chapter where major changes has happened is tax rates and capital gains head, guys. Yes. So first, tax rates for different types of assessee for assessment year 25-26, and here under default regime, whatever concessional tax rates we had, there is a small change there, guys. Small change there. Sir, basic essential limit is 3 lakh. It was 3 lakh. It will continue to be 3 lakh. No problem with that. Then there is a small changes here. 3 lakh to 7 lakh is 5%. Then 7 lakh to 10 lakh is 10%. 10 lakh to 12 lakh is 15%. Then 12 to 15, 20%. More than 15, 30%. That will continue to be same. So previously, if you ask me, this was 6 lakh and no. Yeah. So just update whatever the amounts have been changed. That's all. And rates all will remain same only, guys. Rates, whatever 5, 10, 15, 20 and 30 was there, it is same. Fine, sir. Then coming to companies. Guys, for domestic company, they have optional scheme under section BAA and BAB. Yes, sir. No change in that. But if they are not opting for optional scheme, then we have to check their turnover. Only if their turnover is up to 400 crore, then we consider them as small, 25% is applicable. If not, we are consider them as big company, 30%. Now, sir, for which year should we check the turnover? It is previous year, 22-23. Guys, please be careful. We are deciding the tax rate for previous year 24-25. But to decide the tax rate for the year 24-25, we are seeing the turnover of 22-23. Not even 23-24, 22-23. Yes, sir. Then coming to foreign company, the tax rate has been reduced from 40 to 35 now. It was 40 before, now it is 35, guys. Yeah, now very important and the major changes has happened here. Sir, that means whatever I have studied, the tax rates with respect to special income, should I forget everything? No, you have to remember that along with these new changes. Because guys, wherever changes has happened, this is that special tax rates with respect to capital gains special income. So in respect to that, from 1st April 24 to 22nd July 24, the old rates will continue. The change happened from 23rd July. So 23rd July to 31st March, the new rates are applicable. That means, sir, what am I supposed to know? Both. As both are relevant for the previous year 24-25, you are supposed to know both. Sir, then when what rate is applicable? Depends on the date of transfer. If the date of transfer is between 1st April to 22nd July, old rate would be applicable. Old rates. Whereas if the date of transfer is between 23rd July to 31st March, then new rates, guys. So you are supposed to know both. Okay. So the changes are in special rates, which are applicable on special income. You already know, guys, special income, whoever is having it, whichever scheme they are following, the tax rates would remain same. Now, what are the tax rates, guys? 111A first. 111A. What is 111A covering? Short-term capital gain on the transfer of E, F, T. I call them in short. What is it, sir? Equity share in a company, unit of equity oriented fund or unit of business trust. So E stands for equity share. F stands for equity oriented fund. Then T stands for unit of business trust. Yes, sir. Now, what is the tax rate, sir? 15% if you have sold this on before 23rd July. That is in between this date. I mentioned it. Yeah. Sir, what if I have sold it on or after 23rd July? Then the tax rate is 20% increase by 5%. Before it was 15, but now it is 20%. But the condition is you should have paid securities transaction tax. Sir, what if I have not paid securities transaction tax? Then the short-term gain is not covered here. Short-term gain is not covered here, guys. Okay. Sir, 111A is not covering all the short-term capital gains, sir. It is covering only EFT. What about others, sir? For example, short-term capital gain on the transfer of land, building, gold and all. What about it, sir? It is a normal income taxable at normal rate as applicable to the assessee. Yes. Note I have given. All other short-term capital gains are taxable at normal rates applicable for the assessee, guys. Hope it is clear. So only short-term gain on the transfer of EFT is special. Any other short-term gain is normal income taxable at normal rate. There is no change in that. Okay, sir. Now let me move to 112A, guys, because 111A and 112A covers the same assets, but the nature of the asset is different. Here it is long-term. 112A. Long-term capital gains on the transfer of, again, EFT. Equity share in a company, unit of equity oriented fund or unit of business trust. Here, even here, the condition is if it is a equity share, both at the time of purchase as well as sale, securities transaction tax has to be paid. If it is a unit of equity oriented fund or unit of business trust, securities transaction tax has to be paid at the time of sale. Only then it is covered here. Okay, sir. Then what is the tax rate? If the transfer has happened before 23rd July, tax rate is 10% in excess of 1.25 lakh gain. But if the transfer has happened after 23rd July, then the tax rate has been increased to 12.5% in excess of 1,25,000 gain. Guys, please be careful. Whatever is the long-term capital gain on the transfer of EFT, first you have to include it in your total income. While calculating tax, you have to reduce 125. And 125 is per annum. Sir, can I claim before 23rd July also 125 and after 23rd July also 125? No. They have put on condition telling total exemption in the previous year cannot exceed 1,25,000. Whenever you have sold before 23rd July or after 23rd July, maximum you can claim is maximum tax you will not pay on the gain of 1,25,000. Very clear on that. But please be careful. Previously, this limit was 1 lakh. Now they have increased it to 1,25,000. By increasing the tax rate from 10 to 12.5, they increase the limit for 125. But 125 is not available only after 23rd July. It is available even before 23rd July also. But maximum per year 125. Listen, I will explain with an example. Assume guys you have a 2 lakh long-term capital gain before 23rd July. Sir, I have to pay tax on how much, sir? First include 2 lakh in your total income calculation. Under which head, sir? Capital gains. Full 2 lakh you include. Then while calculating tax, first you will calculate tax on special income. Yes, there you reduce 1.25 into 10%. Into 10%. Sir, same year, I again have 1 more lakh gain after 23rd July, sir. Straight away taxable at 12.5%. Straight away taxable at 12.5%. Sir, you told up to 1.25 not taxable. That is for the year. I already claimed it. I have already claimed it. So in simple, if I have to tell, assume it is in the same year, guys. First include 3 lakh as long-term gain under capital gains head while calculating total income. How much? 3 lakh. Now, while calculating tax, it should be different. Sir, on 75,000, 10%. On 1 lakh, it is 12.5%. Hope it is clear. Yes, sir. Now, let me change the scenario. Sir, assume I have only gain 3 lakh gain year after 23rd July. Straight away minus 125. First include 3 lakh in your income. Then while calculating tax, minus 1 lakh 25. Remaining 1 lakh 75,000 at 12.5%. At 12.5%, guys. Okay. Sir, one more thing. Guys, assume I have 2 lakh gain year, 2 lakh gain year. 2 lakh each. Sir, how is it taxable? First include 4 lakh in your long-term capital gain under the head capital gains while computing total income. Include full 4 lakh. Okay. Now while calculating tax, what should I do, sir? 1 lakh 25,000. Should I reduce it from this or from this? This question is not answered in the law. This question is not answered in the law. They are not openly told it. But what I can understand is FIFO basis. FIFO basis, guys. Means, sir, it is 1 lakh 25 you will reduce from this. Remaining is how much? 75,000. Pay tax at 10%. Now on this, straight away, 12.5%. 12.5%. See, if they had used the word whichever is beneficial to the assessee, then I would have done it in a reverse way. If they had used the word whichever is beneficial to the assessee. See, this is what you have to follow, but I will just change it. Assume they have used the word. They have not used it. Assume they have used the word whichever is beneficial to the assessee. Then I will reduce 1.25 from here because the rate is more. So here I will pay 75,000 into 12.5%. Whereas here I will pay 2 lakh into 10%. Yeah, but as the law is silent, my personal opinion, my personal feeling, okay, personal feeling in the sense from the law point of view, you have to go by FIFO. You have to go by FIFO, guys. So whatever you would have earned first, adjust 1,25,000 against that. Hope it is clear for you. Then last example, let me quote it. Sir, I don't have anything here. I have 5 lakh here, sir. Long-term capital gain on the transfer of EFT. Then what, sir? Reduce 125. Remaining is taxable at 12.5%. Guys, on the long-term capital gains covered under section 112A, there was no indexation before also. Now also no indexation. You can claim only cost. You can claim only cost, but the pattern and all is bit different, which is already covered for us in the regular class. Same thing continues. There is no change in that. Only tax rate and the limit up to which it is not taxable has been changed. That's all. Now, one small clarification here. Sir, both 111A and 112A covered same asset, but short term, long term. Both the places there was a condition telling STT should be paid, STT should be paid. What if by chance if STT is not paid? Guys, if question is silent, assume it is paid. But now they have clearly given it is not paid, sir. Then what should I do? Short term gain is normal income taxable at normal rate. Not covered under 111A. Long term gain is not covered under section 112A. It will fall under 112. It will fall under 112. Hope it is clear. Because whatever conditions they have put, only if it is satisfied, then the gain will be covered in that section. If not, then we will see the next option. What is it? Fine, sir. Now coming to 112. This is a bit lengthy, so please be attentive here. 12, I have just 112, I have just divided into two parts, guys, depending upon the date of transfer. First, let us see what was there. If the transfer takes place before 23rd July 2024, that is from 1st April to 22nd July. Okay, sir. If you want, you can also 24 to 22nd July 24. Okay, sir. Let me write to be more clear. Now, under that, different assets are there. First, if it is unlisted securities or share of a closely held company. Closely held company is nothing but private limited company, guys. Now, who is the person who has sold it, sir? Means associate. Non-corporate, non-resident or foreign company. Non-corporate means other than company, guys. Foreign company or non-residents. If they have transferred it, then what is the tax rate? 10% without indexation. No indexation for them. Sir, asset is long term. Still no indexation. And not even foreign currency fluctuation. Sir, when I bought, exchange rate was different. When I sold, exchange rate is different. Due to that, I have some gain or loss. Can I adjust it? No. No indexation. No currency fluctuation adjustments. That is exchange rate adjustments. Okay. Sir, what if it is sold by any other assessee? Same assets, huh? But any other assets, assessee like domestic company or residents, then they're telling tax rate is 20% with indexation. With indexation, guys. Then second category of assets. Sir, what if it is listed securities? Other than the unit means of mutual funds or zero coupon bond. What is the tax rate, sir? 10% without indexation or 20% with indexation benefit, whichever is more beneficial to the assessee. That means we have to calculate the gain both with indexation, without indexation, apply the respective rates. On the gain with indexation, you have to apply 20% tax rate. On the gain, whatever you would have got without indexation, apply 10%. Wherever the tax liability is lower, you will go with it. You will go with it. Okay. Other assets, sir, because whatever is covered here is only securities, listed or unlisted. What about other assets, sir? 20% with indexation. 20% with indexation. Guys, if by chance, if the transfer has happened before 23rd July and they are not clear about asset or category, sir, then always go with 20% rate. Always go with 20% rate under section 112. Okay, sir. So we saw first category where the transfer has happened between 1st April to 22nd July. Sir, what if the transfer has happened after 23rd July, sir? That is from 23rd July to 31st March. Even if it is after 31st March also, same rates will continue. But for you guys, the end date is 31st March 25, end of previous year. Okay, guys. So here you see, I will straight away go with this case. Guys, only in one special case, there is indexation and tax rate is different. Any other asset, any other assessee, it is always 12.5% without indexation on the entire amount. Here 125 and all we will not reduce. That is only for 112A. 112, no relaxation, no exemption, nothing. Okay, very easy to remember. Actually, they have simplified here. If the asset sold, long-term asset, is land or building or both, who is the assessee? By resident, individual or HUF. They have purchased it before 23rd July 2024. Means asset is purchased before 23rd July 2024. Common sense. Sir, if I am selling it after 23rd July, obviously I should have purchased it before 23rd July. Why, sir? Assume I have purchased it on 30th July and sold it on 31st August. It is not called long-term. Even I purchased it on 30th July and sold it on 31st March. Still not long-term. So for you guys, you need not worry. See that sale date. So sale asset is already long term. That is why we are computing. Okay, now. So what is the holding period for land or building and all? It was 24 months. Now again, there also some small tinkering and all has happened. We will see that. Okay, guys. In simple, the land or building what you have sold is already long term. That is why you have come here. Yes, sir. You have sold it when? On or after 23rd July. Who are you? Resident, individual or HUF? You have two options. What is the tax rate? Lower of 20% with indexation. That is, you will claim index cost of acquisition and improvement. Or without indexation, the tax rate would be 12.5%. Sir, what should I follow? Whichever is beneficial. Whichever is beneficial. So what we have to do is, only for the assessee who is covered here, We have to do two calculations, guys. Only for land and building. Please be careful. Don't do it for everything. Only for land and building, which is sold by resident individual or HF after 23rd July. You have to calculate long-term capital gain both with indexation, without indexation. For the long-term gain, what you have got with indexation, apply 20% rate. For the long-term capital gain, what you have got without indexation, obviously the amount would be more because you have not claimed indexation. So the amount would be how much? 12.5%. Sir, which one will I go with? Whichever is lower. Whichever is lower. Okay. Sir, in any other case, you remember this. Any other case, it is 12.5% without indexation. Any other case. Any other asset, any other asset. You can see second bullet. Land or building or both acquired by resident individual or HF on or after 23rd July 2024 or other assets other than covered under section 112A. Means obviously if it is EFT, it is covered here. It will definitely not come here. So in simple, guys, assets other than EFT and other than what is covered here. That means, can land and building be covered here? Yes. What if it is sold by non-residents or company, partnership firm? Clear. And they also told if it is purchased after 23rd July, relevant for you guys. Why? Because if it is purchased after 23rd July and if it is sold before 31st March, it is not a long term. It will not come here. It will be a short term gain which is taxable at normal rates. Hope you guys got it. Maybe it will be relevant for the subsequent years, not for our previous year. Okay, because here in this bullet they are talking about land or building which is purchased after 23rd July. After 23rd July and sold also after 23rd July. For our previous year, it cannot be long term, guys. Because obviously the holding period will not cross more than 1 year also. Will not cross more than 1 year also. Even in case of non-residents, long-term capital gain on the transfer of unlisted securities shares of closely held company would be taxable at 12.5% without indexation as well as foreign currency fluctuation. Means they will fall in this category only. This category itself, guys. Sure. Okay. We have covered this. This is one of the most important changes or amendments, guys. Let us move forward. Next, this is not a change, but the update. It is an update, guys. See, rebate, whatever we have already learned, will remain same. When is rebate available to the assessee who is following default regime? Only if the total income of the resident individual is up to 7 lakh. But even if it is more than 7 lakh, marginally we will check it, guys. That is what is this point. Even if it is more than 7 lakh, marginally means by a small amount, we will check rebate by applying these steps. Now, sir, up to what amount should we check this, sir? Not given in the law, but I'm just mentioning it so that it would be easy for you to check and proceed further. So, these steps, guys, you apply only for the resident individual who is following default regime, where total income is more than 7 lakh, but up to 7,22,220. Sir, what if it is more than this, like 750, 780 and all? Even if you apply these steps, you will get rebate as 0. You will get the rebate as 0. Better don't apply. Do the regular calculation. Better do the regular calculation. But please be careful. This is only under default regime. Because under optional regime, only if the total income of the resident individual is up to 5 lakh, rebate is available. If it is marginally lower, marginally higher, for example, 5 lakh 1,000 also, no rebate. No rebate. So this marginal thing is there only under default regime, guys. Next change is with respect to salary head. Standard deduction. Again, one of the major change. Important is what I feel. Guys, standard deduction under the head salary for every employee was 50,000, both under optional regime as well as default regime. But now, under the default regime, the amount has been increased to 75,000. Sir, what about optional regime? It continues to be 50,000. So, standard deduction for every salaried employee under optional regime is 50,000, whereas under default regime it is 75,000. 75. Under which scheme? default scheme, guys. Next, income from house property, second head of income. Guys, charging section 22 is telling the annual value of the property of which the assessee is the owner is chargeable to tax under this head. But there were two exceptions for it. Let me just read it. Annual value of the following properties are chargeable under the head PGBP, but not house property. Which are those, sir? First one, portion of the property occupied by the assessee for the purpose of any business or profession carried on by him. Means assessee is using that building to do his own business or profession, not covered under the head house property. Next, there is a change in this. It was previously, if the assessee is engaged in the business of letting out the property, any property, it was covered under the head PGBP. But now it is only commercial properties. Sir, what if the assessee is letting out residential properties? And letting out residential properties is business. House property. It is covered under the head house property. Calculation is same, whatever format is there. We will take gross annual value, we will reduce the municipal tax paid, everything is same only. Even to calculate GAV, we have to consider municipal value, standard rent, fair rent, everything we have to take. Format is same, no change. I repeat, guys. If the assessee is in the business of letting out of the properties, 2R mark. Is it a commercial property? If yes, whatever rental income is earning, taxable under that PGBP. Next, sir, assessee is in the business of letting out, but residential properties. Then whatever rental income is earning is taxable under the head house property only. Let me read it. Exception means what am I covering? The following is taxable under the head PGBP. What is it, sir? Commercial properties of an assessee engaged in the business of letting out of properties. Below that I have also added a note. If an assessee is engaged in the business of letting out of residential houses, the income generated from letting out of residential house or part of the house by the owner shall be chargeable under the head. Shall be chargeable under the head house property. House property, guys. Okay, this will have an impact even on the PGBP head. Under section 28, if assessee is doing any business, anything he has earned from that business at any time during the previous year is taxable. Here it is only from commercial properties, whatever is letting is covered. Sir, what if it is residential house property? Even though he is doing it in the nature of business, still it is covered under the head house property. I will just read it. If the assessee is engaged in the business of letting out of residential houses, the income generated from letting out of residential house or part of the house by the owner shall not be chargeable under the head profits and gains of business or profession, and would be chargeable under the head income from house property. Noted? Yes. Next, other expressly allowed deduction under section 36(1). Guys, we have under 36(1) 4A, employer contribution to the account of employee under a pension scheme referred to in section 80CC(D). Sir, can employer claim his contribution as deduction? Yes, but maximum how much, sir? 14% of salary. Previously it was 10% of salary, but now it is 14% of salary, guys. Deduction is restricted to 14% of salary of employee in previous year. Salary here would include only basic and DA, that is dearness allowance, if the terms of employment provide, no commission. So previously it was 10, now it is 14. That's all the changes. Next, we are still under the PGBP. Expenses disallowed under 40. So there 40B, which is applicable only for the firms. Interest maximum 12%. Yes, no change in that. Guys, if partnership firm is paying it to the partner, salary, bonus, commission, remuneration, then there was some limit under section 40B. What was the earlier limit, sir? Actual remuneration or the limit as per 40B, whichever is lower, it is allowed under section 40B. Now, what is the limit as per 40B, sir? Guys, we have to first calculate book profit. What is the book profit, sir? It is the profit of the firm after all the expenses, but before remuneration. If remuneration is already debited, please add it back and calculate the book profit. Previously, it was up to 3 lakh book profit. 90% of the book profit or 1,50,000, whichever is higher. And on the balance, it was 60%. But now there is a change in that. So limit, whatever is there, that limit part has been changed, guys. Only that change. Rest all remains same. The limit specified under section 40B is as below. On the first 6 lakh book profit, they have doubled it. How much is the remuneration allowed, sir? 3 lakh, which is a fixed amount, or 90% of the book profit, whichever is higher. Whichever is higher. On the balance, that is when book profit is more than 6 lakh, it is 60%. Sir, what is book profit? Again, I am repeating. The profit of the firm after all the expenses, but before remuneration. Okay, I will just give an example, guys. Assume book profit of the firm, which is already calculated, is 10 lakh. Sir, how do I calculate the limit? On first 6 lakh, it is 90%. On first 6 lakh, 90%. How much amount comes to? 5,40,000. 5,40,000. Or compare with 3 lakh. Obviously, 5,40,000 is more. 3 lakh or 5,40,000, whichever is higher. 5,40,000. Next, remaining amount is how much, sir? 4 lakh. That is 10 minus 6. On that 60%. On that 60%. So 240, 2.4 lakh. So total is how much, sir? 7.8 lakh. Limit as per 40B is 7.8 lakh. Compare this with actual remuneration and whichever is lower is allowed. Whichever is lower is allowed. Next, let me assume. Sir, book profit, let me take it as 5 lakhs. 5 lakh. Straight away, it is within 6 lakh. So straight away take into 90%. 4.5 lakh, yes. Or 3 lakh, whichever is higher. 4.5 lakh. So limit as per 40B is 4.5 lakh. Compare that with actual remuneration, whichever is lower would be allowed. Next, sir, book profit, assume is only 2 lakhs. Sir. Book profit is only 2 lakh. 90% of that comes to 1.8 lakh. Compare that with 3 lakh. Because 3 lakh is like minimum here, guys. Okay. 1 point or 3 lakh, whichever is higher, sir. 3 lakh. Compare this with actual remuneration. Whichever is lower is allowed. Whichever is lower is allowed, guys. Fine. See, please be careful. Don't worry about the entire content I have put here. That is only for your reference I have added here. Because if I just take this, then you will not be able to connect. That's why I just taken the relevant provisions and I have highlighted in red color what is the change. So your focus should be on red color. What is the amendment? Coming to the most important part. Capital gains. The first change here is, guys, in section 46 and 47, they have given the transactions which are not regarded as transfer. Transactions which are not regarded as transfer. So there, the third point has been changed now. You can see transfer of capital asset by an individual or HF under a gift, will or irrevocable trust. Previously, this was not there. Transfer by anyone as a gift, will, irrevocable trust, it was not a transfer. But now they are telling only by individual or HF is not a transfer. Sir, what if company has given a gift, partnership firm has given a gift, it is a transfer. Should we compute capital gains? Yes. But here, exception is, guys, ESOP shares. ESOP shares. Now, if individual has gifted freely or as a will, the shares what he has got under ESOP, he has given it as a gift or will. Is it still a transfer, sir? Yes, it is a transfer. Exception is not applicable. Means it is not covered in section 47. If it is a ESOP shares which is given as a gift or will or irrevocable trust, it is a transfer, capital gains is applicable. Okay. Then, sir, how do we classify the capital asset as long term or short term? Based on period of holding. What is period of holding? The time gap between the date of purchase and the date of transfer. So based on that, we will decide whether the asset is long term or short term, guys. So there are three criteria: 12 months, 24 months or 36 months, depending upon the assets. If you have held the asset for more than 12, 24 or 36 months, we call it as long term asset. When I transfer it, what I get is long term capital gain. And long-term capital gain will always be long-term and taxable at special rates. It is long-term only, but taxable at special rates. Sir, can it be anytime normal income? No, it will always be special income, taxable at special rates. Guys, you know what is covered under 112A EFT? Any other long-term capital gain is covered under 112. Okay, sir. Fine. We'll come to that again. Tax rates, again, I will touch it here also. In case if the transfer takes place before 23rd July 2024, guys, that is from 1st April to 22nd July, we have three criteria. For the following three assets, 12 months is applicable. Listed securities other than unit or recognized stock exchange or unit of equity oriented, not debtor, equity oriented fund or unit of Units Trust of India and zero coupon bond. If you have held them more than 12 months, then it is a long term. Less than or equal to 12 months, short term. Then 24 months, two assets are there. Listed shares and land and building are both. In simple, I call them as immobile property. If you have held them for more than 24 months, long term, less than or equal to 24 months, short term. Okay. Rest all assets fall under 36 months, guys. I've just given few names, but you have to remember this too. Anything else will fall in the last category, 36 months. Unlisted securities other than shares, unit of debt-oriented fund, unit of business trust, other capital assets. Sir, why have you mentioned the name? You would have simply given other capital assets. Yes, that is how they have actually given in the law. But what I have done is, you may get a confusion. Sir, unit of equity-oriented fund is covered here. What about debt? It will fall under 36 months. Then, sir, listed shares and unit of equity-oriented fund is covered here, which is a part of EFT. T is missing, sir. Where is T, sir? Actually, it is here. Assets comes under different months category, whereas covered in the same sections, whether it is short term or long term. If it is short term, 111A, whereas if it is long term, 112A, guys. Okay, now this is the change. Sir, what if the transfer happened on or after 23rd July? In that case, only two criteria is there. You remember only this. Rest all will fall in 24 months, guys. Not 36 here. So, which are those, sir? Same copy paste. Same three assets have now been placed at 12 months only. All other assets, 24 months. That means simplified, guys. This two, they have merged it into one now. 24 and 36, whatever was there, now they have made it as 24. Only two criteria are there, not three. Okay. How will you decide? Based on the date of transfer. When is the transfer happened? Accordingly decide what is the period of holding applicable. And then check what is the time gap between the date of purchase and date of sale, guys. Fine, sir. Next. If it is assets covered under section 50AA, where we always calculate short-term gain, guys. It was added last year, 50AA. We always calculate short-term gain. We will not even check period of holding. Sir, which are the assets covered under section 50AA? Two assets were already there. Now they have added the third one. Which were the two assets before, sir? Units of specified mutual fund acquired on or after 1st April 23 and market linked debentures. These were already there, guys. Now they have added one more from 23rd July. Unlisted bond and unlisted debenture, which is transferred or redeemed or matures on or after 23rd July. This is the new item. And if you have transferred any of this, don't even check period of holding. It is always short term. Taxable at normal rate. Even 111A doesn't cover this. Okay, sir. Now, guys, for any long term assets, we have a benefit of indexation. But if the transfer happen on or after 23rd July, even though it is a long term asset, indexation benefit is not available. But only on land and building sold by resident individual or HF, indexation is available. They have a choice with or without indexation. In any other case, no indexation, even though the asset is long term, guys. Okay, coming to tax rates, which I already covered. I covered it in tax rates chapter only. Same thing is repeated here also. Yeah, then 112A, how to calculate the cost, whichever is lower, those things and all, same thing will continue, guys. There is no change in it. Okay. Yes. Now, before I go forward, I've just made a chart on this. Okay, just to simplify it, I will just quickly go through this. Observe, guys. Capital gains on the transfer of EFT, equity shares, F, units of equity oriented fund, T, units of business trust. Check whether it is long term or short term. If it is long term capital gain, which section is applicable, sir? 112A. 112A. What is the tax rate, sir? If the transfer is between 1st April 24 to 22nd July, the tax rate is 10% in excess of 1.25 lakh. Whereas if the transfer is from 23rd July to 31st March, the tax rate is 12.5% in excess of 1.25 lakh. Guys, in excess of 1.25 lakh is per annum, not for both. It is per annum. Please be careful. Yes, sir. This is when it is 112A. Please be careful. Whatever is the long-term capital gain on the transfer of EFT, first include it fully in your income calculation. Only while calculating the tax, you have to reduce 1.25 lakhs. Then, sir, what if it is a short-term capital gain? Means the EFT, what I have transferred, is a short-term asset, sir. So what I got was short-term gain. Is it special? Yes, it is special. Covered under section 111A. Here also, date of transfer matters. If it is between 1st April to 22nd July, the rate is 15% on the entire amount. No exemption, nothing here. Whereas, if the date of transfer is from 23rd July to 31st March, the tax rate is 20% on the entire income. No benefit here, guys. Only for 112A, we have a benefit of up to 1,25,000. Only for 112A. Yes, sir. The condition for both of them is STT should be paid. Sir, what if STT is not paid? Then short term will be a normal income taxable at normal rate and long term will be covered under 112, not 12A. Okay, sir. So this was only on EFT, guys. EFT. Sir, what if I have earned a capital gain on the transfer of any other asset? Then capital gain on the transfer of any other capital asset other than EFT. Long term, short term. Short term, very easy. If it is on the transfer of any other asset, always normal income taxable at normal rate. Normal rate means what, sir? Whatever rate applicable to the assessee as per the scheme he is following. He is following. Okay. Now coming to what if it is long term capital gain? Again, date matters. Between 1st April to 22nd July, three categories of assets are there. First, unlisted securities. Who is the assessee? Non-corporate, non-resident or foreign company? Then what is the tax rate? 10% without indexation and without currency fluctuation. Then if it is other assessee, sold same unlisted securities only but other assessee, then it is 20% with indexation. Then second category of asset, listed securities or zero coupon bonds. They have a choice, 10% without indexation or 20% with indexation, whichever is lower. Last, other assets, then in simple other than securities and zero coupon bond. 20% with indexation. With indexation. Indexation is available. Okay. Sir, what if the transfer is between 23rd July and 31st March? Then, if the asset sold is land or building by a resident individual or HUF, which was acquired before 23rd July, then they have a choice. They can claim indexation by paying 20% tax on it. No, if they don't want to claim indexation, then the tax rate is 12.5%. They will choose whichever is lower, guys. Option has been given to them. If it is other assets or other assessing, which is not covered in first point, then all other will come under second case. No indexation, the tax rate is 12.5%. Okay, sir. This is all about the capital gains special income, guys. The major changes has happened there. Okay, just to summarize, I have just put a table here. This is before 23rd July. I have not highlighted in red color because this was already there, but I have placed everything in one single table so that you guys get a more clarity. Summary showing the indexation benefit available to different types of long-term capital assets which are transferred before 23rd July. Okay, means which was already there. Bonds or debenture, no indexation, guys. Except capital index bonds and sovereign gold bonds. For that, indexation is available, sir? Yes. Any other bonds or debentures, no indexation. Even if it was before 23rd July. Fine, sir. Next, depreciable assets means on which section 32 depreciation failed because there is no asset in the block or no value in the block or no asset in the block. Section 32 failed. Immediately section 50 will take over. What do we calculate under section 50? Short-term gain or loss. Always short-term gain or loss, irrespective of the period of holding. Sir, for that, can we claim indexation? No, because it is always short-term. No indexation. Always calculate short-term gain or loss under section 50. Then unit of specified mutual fund, market linked debentures. Then even now they have added unlisted bonds and debentures. But I am not included here because I am talking about before 23rd July. Before 23rd July. Because that bonds and debenture unlisted was added only after 23rd July. That is why I am not given it here. Okay, sir. So for this too, which is covered under section 50 AA, it is always short term. We don't even care about the period of holding. Guys, please be careful. Both these sections, whatever we calculate, short-term gain is always short-term, taxable at normal rate applicable to the assessee. It is not even special. Okay. Next, equity share in a company on which STT is paid both at the time of acquisition and transfer. Unit of equity-oriented fund or unit of business trust on which STT is paid at the time of transfer. Both are covered under 112A. For 112A, asset is long-term, gain is long-term, but no indexation. Guys. Then any other long-term capital assets like land, building, gold and all, yes, indexation is available. Only if it is sold before 23rd July. Yes, sir. Now, what are the amendments, sir? From 23rd July. Okay, you gave me in this table, what if it is before 23rd July? Sir, what if it is after 23rd July? Consequent to the amendment made by Finance Number 2 Act 2024 in Section 28, no indexation benefit is allowable on long-term capital gain arising on transfer of any capital assets taking place on or after 23rd July, except land and building transferred by resident individual or HUF, on which indexation is optional at the benefit of the assessee. So, for them, I have given the second paragraph. A resident individual or HUF, while computing the tax on long-term capital gain on the transfer of land, building or both, has the option to take the benefit of indexation under section 112 option in respect of long-term capital gains arising on the transfer of land or building or both, which is acquired before 23rd July and transferred on or after 23rd July. Only in this case, indexation is available. Any other asset, any other assessee, no indexation. Accordingly, long-term capital gain on the transfer of such land or building or both are subject to lower of tax at 12.5% on long-term gain computed without indexation or at 20% on long-term capital gain computed with indexation. That's all, guys. This is an amendment part, whatever I have given in the red color. Capital gains done. Let us move towards last head, that is income from other sources. Yeah, there, income from family pension. Guys, previously it was 1/3 of the family pension or 15,000, whichever is lower. But now under default regime, there is a change. For the assessee who is paying tax under default regime under section 115 BAC, standard deduction under section 57(2)A, that is for family pension, is 1/3 of such pension or 25,000, whichever is lower. So if the assessee is following the person who is earning the family pension, not the assessee is gone. These family members are receiving family pension. Where is it taxable? Other sources. If that the person who is earning the family pension, assuming nominee, if they are following optional regime, then they will be eligible to claim a deduction of 1/3 of such pension or 15,000. If they are following default regime, then 1/3 of such pension or 25,000, whichever is lower. So under optional, it will continue to be 15 only. Only under default, they have made it as 25. Then coming to taxation of dividends, guys, dividend income for the shareholder will always be taxable under the head other sources at normal rate, including deemed dividend. But deemed dividend definition has been extended to include one more item. What is that one more item, sir? Buyback of securities by a domestic company. What is this? I will just explain. Guys, if a domestic company buy back their shares on or after 1st October 24, not 23rd July, here 1st October 24, then whatever they pay to the shareholder, the sale value or buyback price, what we call, straight away that will become a deemed dividend in the hands of shareholder whose shares has been bought back. He cannot claim any expenditure, not even cost of acquisition he can claim. Straight away, whatever buyback price he will get, it is considered as income from other sources. Sir, what about the purchase price you would have paid to purchase that share, sir? It will be a long-term loss or short-term loss under the head capital gains. That loss can be adjusted as per the provisions of set off and carry forward of losses chapter. Yes, let us see. Along with some illustration I have put it here. F, clause F is the newly added thing. In case of buyback of shares, whether listed or unlisted, on or after 1st October 24, guys, by a domestic company. Who is doing it? Domestic company. Any sum paid by a domestic company, which is nothing but buyback price, for purchase of its own shares would be deemed as dividend in the hands of shareholder and shall be charged to income tax at the applicable tax rates to the assessee. That is whatever is the rate applicable for him, because dividend income is never a special. No deduction for the expenses would be available against such dividend income while determining the income from other sources. Okay, means he cannot claim any expenses, guys. I have given one illustration. Let us quickly go through it. Number of shares of A Limited bought in 2020 by Mr. B at 400 per share. No, 100 shares he has bought at 40 rupees per share. 100 shares. What is the total cost of acquisition? 4,000. Now, number of shares bought back in November 2024. That is during our previous year. After 1st October, yes, please observe that date also. Number of shares bought back in November by A Limited at 60 per share. Now, how much did he receive? 60 into 20, 1,200. Straight away income from other sources. Straight away. Dividend income. Okay. Now, what about the cost, sir? This 20 shares didn't come for him freely, no, sir. He paid 40 rupees. What about that? He will claim it as a loss under the head capital gains. So, you can see deemed dividend is 1,200, whereas long term, it is a long term asset. Long-term capital loss on such buyback as per section 46A, value of the consideration will be considered as nil because it is already taxed under other sources. What is the cost of acquisition? Minus 40 into 20. It is 800. So what is the long-term capital loss? 800, guys. Now, what do I do with this long-term loss, sir? You adjust it only against long-term gain. Long-term gain. So in the future, if you have earned any long-term gain, or in the same year, if you have any other long-term gain, you can adjust it or carry forward for next 8 years and adjust it only against long-term capital gain, guys. So I have also continued and told number of shares sold, not bought back, sold in December 2025 by Mr. B at 70 per share. 50 shares he has sold. Sir, what is the long-term capital gain? 70 into 50 is the sale value minus the cost of it. 40 into 50, 1,500. So, is entire 1,500 taxable, sir? No, he has a loss of 800. Can I adjust it, sir? Yes, as it is long-term gain, long-term loss can be adjusted. So, against 1,500 gain, 800 loss has been adjusted. Remaining 700 would be taxable. Remaining 700 would be taxable. Okay. Now coming to deductions allowable under section 57. Guys, in case of if you have incurred any interest expenditure to earn dividend income, you can claim the expenditure. Yes. How much, sir? Actual interest expenditure or 20% of such dividend income, whichever is lower. For example, sir, my dividend income is 1 lakh. But to earn this dividend income, I have taken some loan and I have invested, sir. I am paying interest. How much interest I am paying? Assume 30,000. Now, can I claim full 30,000 expenditure? They are telling no. Actual interest or 20% of this, which comes to 20,000. Whichever is lower, I can claim. Whichever is lower, I can claim. Whichever is lower comes to how much? 20,000. So against 1 lakh, I can adjust 20,000. Remaining 80,000 is my income from other sources, guys. But if it is a deemed dividend under section 222F with respect to buyback, they're telling you cannot claim any expenditure. You cannot even claim cost. You cannot even claim interest. Any expenditure you cannot claim. You can say, just read that. No deduction in respect of any expenditure is allowed in case of deemed dividend arise on account of buyback of shares by a domestic company. It is straight away sale value is taxable as dividend income. Okay. With respect to family pension, I have already told you, for the assessee who is following default regime, it is 1/3 of the pension or 25,000, whichever is lower, guys. Okay. Coming to deduction chapter, third point there, CCD. CCD, guys. This point I will read. See, with respect to CCD, both employee's contribution as well as employer contribution can be claimed as deduction. Both employee as well as employer. But employer contribution, first add it to your salary income and then come and claim the deduction here. In that, there is a change, guys. Subsection 2. Okay. Let me read that full section only. Subsection 2. Contribution made by central government or state government or any other employer in the previous year to the said account of employee, that is NPS account of the employee, is allowed as deduction in the computation of total income of the assessee. This deduction is out of the focus of section 80 CCE, means 1,50,000 limit is not applicable for this. Okay, sir. Now, what is allowed as deduction, sir? Is everything or any limit? The entire employer contribution would be first included in the salary of the employee under the head salary. However, deduction under section 80 CCD subsection 2 would be restricted to 14% of salary in case of contribution made by central government, state government. Okay, only for government employer it was 14%. Whereas for others, 10% of the salary in case of contribution made by other employer. That is other than government, non-government. But now, if the employee is following default tax regime, instead of 10%, they told it is 14%. If employee is following. Sir, what if employee is following optional regime? Then 10%. I repeat. If the employer is central or state government, irrespective of which scheme the employee is following, it is always 14% of salary. But if the employer is non-government, 2 R. First one. Which scheme the assessee is following? Assume default regime, 14% of salary. Sir, employee is following optional regime, 10% of salary. 10% of salary, guys. Even in this table, 10% is there, don't scratch it. But if the assessee is following default regime, then it is 14%. Then it is 14%. If you remember, even in PGBP, they have changed. Previously, it was 10%, whatever is allowed to the employer as expenditure. There also, they have increased it to 14% to any employer. There is no distinction. There, they have not told which scheme employee is following. Doesn't matter. For employer, 14% is allowed maximum. 14% of salary. Salary here means basic pay plus DA with condition. Okay. Next, TDS, TCS and provisions of advance tax. TDS, there are some changes. TDS. Changes means it is again partially part of the year. You should remember both old rate as well as new rate. Okay. And this sections I have arranged it. So remember everywhere. Wherever it was 5%, now they have made it as 2%. Not everywhere. These sections. What are those, sir? I will just tell you. 194 DA, that is life insurance sum. 194G, that is commission on sale of lottery ticket. Then 194H, commission or brokerage. Then 194IB, payment of rent by certain individuals or HUF. Then 194M. For all these sections, the rate was 5%. 5%. But now from 1st October 2024, they have reduced it to 2% for all these sections, which is common. So that means if the payment is made between 1st April to 30th September, if it is crossing the threshold limit, you have to deduct 5%. If the payment is made after 1st October till 31st March, on or after 1st October till 31st March, you have to deduct a TDS of 2%. Guys, one thing to be careful here is, sir, whatever threshold limits they have given, assume this 15,000, it is per annum. Now, sir, for example, before 30th September, I had paid 10,000. After 30th September, I paid another 10,000. Should I deduct TDS? Yes. When did it cross 15,000? After 1st October. So, as the aggregate payment is more than 15,000, on entire 20,000, 2% has to be deducted. Because the threshold crossed in the second half. Now listen, one more story. Sir, before 30th September only, I had already paid 20,000. So how much TDS to deduct, sir? 5%. And after 1st October, again I paid another 50,000, sir. How much TDS to deduct? 2%. 2%. Now, sir, before 30th September, I had paid 10,000, sir. And after 1st October, 3,000 is paid, sir. Should we deduct TDS? No TDS. Clear? So we have to see, when did this 15,000 cross? It should be aggregate. Not 15 before 1st October, 15 after 1st October. No. It's per annum. Not only here, every section. I just took one section as an example. Everywhere, whatever is the threshold limit, it is per annum. Both the half put together. Both the half put together. Yes. Then one more section. 194. Whoa. It was 1% of the gross amount of sale. But from 1st October 2024, it would be 0.1%. 0.1%, guys. That's all. There is no new section and all. Whatever sections were already there, in few sections, they have made it lower rates. But from 1st October, that is the second half of the financial year, guys. Okay, sir. Then coming to TCS, tax collected at source. Guys, there we have section 206C1F, which covers sale of motor vehicles whose ex-showroom price is more than 10 lakh. Only motor vehicle was covered. But now government has taken the power, telling I can add any other items here. Only motor vehicle was there, na? Now they have taken the power to add any other item. Sir, have they added any other item? No, as on today, not added. Thank God. With effect from 1st January 25, again a part of our previous year only, last 3 months. Okay. The scope of section 206C1F has been expanded to include every person being a seller who receives any amount as consideration for sale of any other notified goods. Any other notified goods exceeding 10 lakh. That is, if sale value is more than 10 lakh. 2, or at the time of receipt of such amount, collect tax from a buyer at 1% of the sale consideration. So in simple, guys, I repeat again, only sale of motor vehicles in excess of 10 lakh was covered here. Now government has taken a power to add any other item, any other goods. As on today, they have not added any other goods. Relax. Okay. Now coming to TCS under section 206C1G. Guys, here there is no amendment. It is just a clarification from my side. If you have attended the class or studied previously, then there would be 2 rates, because in between the year the rate changed last year. Clear? That there also 1st October. But now for the previous year 24-25, only 1 rate. The new rates. Sir, what about the old rate? Went for last year only. Forget about it. Okay, so for our previous year 24-25, only these rates. Hope you guys got it. So only this one. The new rates, whatever you would have studied, only that will continue now. Okay, last chapter 15. So here also, whatever I already mentioned in tax rate chapter, same thing. Domestic company who is not following optional schemes, check their previous year 22-23 turnover. 22-23 it is. Then for foreign company, the tax rate is now 35%, guys. Okay. Now coming to buyback. Now coming to buyback. We covered deemed dividend, but buyback is covered here. Guys, simplified. I have just given a table. That is better more. Instead of reading all the stories. Listen here. New story I will read. Old story you already know it. Okay? Yes. Sir, if it is buyback of ESOP shares by any company, who should pay tax, sir? Shareholder. So for whatever capital gains income the shareholder has, he will pay the tax. Whether short term or long term, he will pay tax. Should company pay tax? No, sir. Next. Sir, if it is a buyback of shares by a domestic company, whatever was already there, who is liable to pay tax, sir? Company. At what rate, sir? 23.296. Sir, what is this odd figure? Actually, tax rate is 20%. Plus surcharge always 12%. Plus cess 4%. Effectively, the rate comes to 23.296%. Sir, how is it possible, sir? You don't know the basic maths. 20 plus 12, 32. Plus 4, 36, sir. Guys, please be careful. 20% is on the income. Whereas 12% and 4% is on the tax amount. So it should be 20 plus 12%. Whatever you get here, plus 4%. So surcharge is always on gross tax, not on income. 4% cess is always on gross tax plus surcharge. Yes. Okay, sir. Who should pay tax? Company. Which company? Domestic company. Sir, should shareholder again pay tax? No, it is exempt in his hands. As company has already paid tax. And guys, we call it as additional tax. Why, sir? Because company would have paid tax on their own income. Plus now, they have to pay tax on the capital gains income of the shareholder. But will shareholder again pay tax? No, exempt. Okay. Amendment part I will take care. Then, sir, what if any other company has bought back the share other than domestic company? Then shareholder is liable to pay tax always. Compute the capital gains income in the hands of shareholder, he will pay tax. Sir, how to compute the capital gains income in the hands of shareholder? Sale value, full value, normal calculation. Full value of sale consideration is buyback price. From that, you reduce cost of acquisition. That is what price you would have paid to purchase it. Yeah, so please be careful. First, you go with this buyback. Any other shares bought back. If it is a domestic company, then different story. Any other company, then different story. Okay, sir. Now, sir, what is the change? This was already there. This was already there. What is the change, sir? Guys, if the buyback happened before 1st October 24, then the company is the one who were liable to pay tax. But now they have changed it. From 1st October, shareholder will pay tax. Under which head? Income from other sources. Nature only changed. It was capital gains for before. Now they have made it as income from other sources. We already covered 222F. Nah? Same thing, connected. Whatever is the buyback price the company paid to the shareholder is deemed dividend income in the hands of shareholder, taxable at normal rates as normal income. Can he claim any expenditure including cost of acquisition? No, you cannot claim. No, you cannot claim. Yes. Sir, should company pay tax on it? No. I will just read it. What is the change? So this third point is a new point now, guys. First, 1 and 2 we would have already seen. Third is new. Let me read it. In case of buyback of shares effected on or after 1st October 2024 by a domestic companies. In case of buyback of shares, whether listed or unlisted, on or after 1st October 2024 by a domestic company, the sum paid by domestic company for purchase of its own shares would be treated as dividend and taxable under the head other sources in the hands of shareholder. No deduction for any expenses would be available against such dividend income. No expenditure, nothing you can claim. Consequently, sir, what about my cost of acquisition? Claim it as a loss. Consequently, as per section 46A, value of consideration received by a shareholder on buyback of shares by a domestic company would be nil. Sir, he received the money. Yes, it was taxed under the head other sources. So under capital gains, full value of sale consideration would be nil. And the difference between the cost of acquisition and the value of consideration received by the shareholder will result into capital loss. The same can be set off and carry forward as per the applicable set off and carry forward provisions of the Act. If it is long-term capital loss, it can be set off only against long-term capital gains. If it is a short-term capital loss, it can be set off against long-term gain or short-term gain, guys. So while studying this, better study it along with 222F, which I covered it under the head other sources, because these two are interconnected. Fine, guys. So this is all about the amendments as applicable for June 2025 exams in direct tax. All the best. Do well.